When searching through for suitable investment, it is extremely important for us to look into a few important factors. And here are 5 kind of stocks that we should definitely avoid as beginners. The stock market can feel like a minefield at times, and we can unwittingly step on a landmine even though we think that we are being careful. So how can we really avoid investing into higher risk company that might cause us to lose our hard-earned investment capital? Here are 5 kind of stocks to avoid for beginners investors. Number 1, high debt company. In general, companies that carry high level of debt are riskier. During good times, debt can be used as a fuel to supercharge return and growth. However, when the economy heads south, a heavy debt burden can cripple a company. As Warren Buffett once said that you do not want to rely on the kindness of strangers to meet tomorrow's obligation. One of the most recent examples is definitely China Evergrande Group. The company now faces more than $300 billion in debt and hundreds of unfinished projects and many angry suppliers and customers. Share of the company has fallen more than 80% this year. So one way you can spot high debt company is just by looking at its debt to equity ratio. The debt to equity ratio is calculated by just dividing its total debt by its total shareholder equity. As a general rule of thumb, a debt to equity ratio of more than 1 can be considered as higher than normal. Number 2, modeless company. Coined by Warren Buffett, an economic mode is a distinct advantage a company has over its competitor, and that allows it to protect its market share and its profitability. It is often a unique advantage that a company has that is difficult for competition to duplicate. Thus, this creates an effective barrier against its competitor. Company with wide moats tends to have higher operating margin and profitability. They are also most likely to be leaders in their respective industry and could even gain market share along the way. Example of such businesses includes Apple with its established brand, Facebook with its huge network effect, and even Walmart, which have a huge cost advantage due to its economic of scale. Conversely, companies that lacks a wide economic moat usually have the opposite characteristic. They do not have pricing power, they lack track record of generating consistent profit and also free cash flow, and they tend to have very low margin and is very dependent on the industry macro environment to grow. So this is also a type of company best avoided if you're just new to investing. Number 3, penny stock. Penny stock are high-risk security that trades at very low share price. New investors are often attracted to penny stock as they believe that there is more upside due to the low share price. But the trouble is penny stock are often tied to unproven, unprofitable, and even sometimes questionable companies. The stock can be very illiquid and very volatile, so it can be easily manipulated by speculators. For example, speculators might buy shares of such penny stocks. They hype it up online by spreading positive rumors and then causing others to buy in and drive up the price. And this is the point where speculators might sell the shares for big profit, leaving investors with huge losses. This is also what we call a pump and dump scheme, which is made famous by movies such as Wolf of Wall Street. We have also seen more recent examples with the rise of meme stock in the past few years. If you are more interested to create sustainable long-term wealth, then it is best to just avoid such stock. Number 4, companies in sunset industry. A sunset industry is an industry in decline, one that has passed its peak or boom period. An example might be the print media industry. Let's do a poll together. When's the last time you bought and flipped through a physical newspaper? Comment down below and let us know. For me, my phone is basically my newspaper today. So such a decline in the industry has really caused companies such as Singapore Press Holding to see its revenue shrink around 60% from 1.1 billion in 2006 to less than 450 million in 2020. Its share price has also fallen by roughly half in the past 5 years. The value of the business will be linked to the growth of a business. So as investors, we should avoid companies in sunset industry that hold little promise of future development and growth. 5 companies in cyclical industry. Lastly, investor might need to be mindful when investing in companies in cyclical industry. These are companies often experiencing extreme peak and trough in their business cycle. Say, take the oil and gas sector for instance. Crude oil price can plunge very suddenly and very sharply, such as what happens a few years ago, and that will create huge pressure for oil and gas company. Even industry leaders like ExxonMobil face a huge drop in revenue back in 2014 to 2016 when oil price crashed. Company within cyclical industry experience boom and bust, which is very hard to predict. Even veterans in the industry could confess that they have very little insight to how to predict those commodity prices accurately. Therefore, it is best that we just avoid this company if we have no special knowledge of the industry. So there you have it. These are 5 kinds of company that we should avoid as new investors. If you have gotten value from this video, please give us a like and share with your friend who you might think will benefit from it as well. If you're ready to take the next step into investing, you can also check out our free investing course at valueinvestasia.com/free course. There we'll teach you practical skills like how to read a financial statement to how to value a stock. As always, till we meet again, my name is Stanley. Invest safely.